will be punctual. 6 p.m. We're ready to go. Thank you, JoAnne, for joining us this evening. Let me go to my next slide. So tonight, everyone, thank you all for joining us. We have Dr. JoAnne Feeney here joining us, the portfolio manager and economic analyst for Advisor Capital Management, one of the preeminent money managers out there. So we appreciate you joining us, Dr. Feeney. Before I get into introducing Dr. Feeney, I do want to mention a couple of things. I do have my book, so don't forget that's available on Amazon. The Great Retirement Mystery: How to Avoid the 6 Biggest Blunders. Tends to be, people tell me anyway, it's helpful to them in understanding financial planning and what to do. It's really for any age. I do have it titled The Great Retirement Mystery, but it really it's for anyone. So on Amazon, you can find that. So before I introduce JoAnne, I do want to talk about my master proprietary process for a moment here. That is a really wise way I've found of managing assets for people when I have diversification in asset management and asset classes for people. So JoAnne is in the red part here, the M of my master proprietary process, MAS. So M is managed money, anything to do with stocks, bonds, or mutual funds, and I'll let JoAnne dig into that this evening. The alternative space, those are a lot of times private placements or real estate programs, anything that does not trade with the stock market. So a lot of my clients do love those because they don't want all their assets in the market. And then S is safe money. So that's any insured product. So if you tell me, hey, Kelley, I want no risk whatsoever, that's where we go for that. So the world of investing is here somewhere. And again, we're going to focus this evening on the red part, the managed part, the stocks, bonds, and mutual funds, and specifically stocks this evening. So just to give you an overview of that. So again, we're going to introduce Dr. Feeney. She is a very dear friend of mine. So again, thank you, JoAnne. Dr. Feeney is a portfolio manager for Advisors Capital Management and manages the growth and balance strategies. She served as a member of the firm's investment committee, which includes former Federal Reserve Chairman Dr. Alan Greenspan, as well as senior economic advisor, and also has made multiple appearances on Bloomberg, CNBC, and Fox Business. So we are very pleased and thrilled to have her here with us tonight. So with that, JoAnne, I'll give it to you, and thank you so much.
Oh, it's my pleasure. Can you enable screen sharing, Kelley, or something so I can take control?
I thought you were a panelist. Are you not a panelist?
Yeah, it said, sorry, we should have tested this. It says host disabled participant screen sharing. I think you can enable me if you click on my name under participants or something.
Should be co-host now.
I could do it.
Yeah.
Yes, I got it. Good
Okay.
work. Okay. Okay, so you guys should be able to see my screen.
Yep.
Perfect. Okay,
Okay,
so
before you jump in, excuse me, I'm so sorry. If anybody has any questions, please type them in the chat and we'll try and get to them at some point in the evening if we don't answer them during the call.
I'm gonna move this over here so I can look at everybody while I do this. Okay. 1 second. Okay. Oh, it didn't work. Slideshow, please. I'd like to get rid of all these bars. Hold on 1 second. Apologize for this, guys. Stand by.
No worries, you take your time.
All right. What okay, can you see just the slide, or can you see also the borders showing the other slides?
I can see the border of the next slide.
Rats.
We couldn't figure out how to get that off either. Oh, she said it looks good. No, it looks good. Okay, sorry, I'm looking at 2 different screens.
Oh, okay. You're just seeing the main slides?
Yes. You're
Okay,
good.
cool. Okay, so today's agenda, you know, the title, I think showed it all, which was, you know, macroeconomics markets update. So today's agenda, I want to just talk a little bit about where we are and how we got here in terms of what's moving in the market, both just in recent past and also from the beginning of 2020, so how we got here from COVID, and talk about some of the main issues that are plaguing investors. I'm sure you're well aware of many of these: slowing growth and a possible recession. In fact, the United Kingdom today, when they raised rates, they said we are expecting to be in a recession for a prolonged period of time. So recession is gripping the world, and that does require patience of investors. We've been through cycles before. This is not the first time. And we know that they end. We know that recessions end, and we end up in a better place with stronger growth outlooks. But there are other risks out there. Obviously inflation, rising wages. Supply chains were snarled for a while. They're getting a whole lot better. And now, in fact, we're seeing oversupply in some places. And China's zero COVID policy is not just a problem if you live in China. It's also a problem for manufacturing more broadly. And that's creating, all of those things are creating risk to earnings. And of course, then we also have the Russian invasion of the Ukraine, which is further complicating supplies of some commodities, and it's drawing resources away from a lot of Western countries who are trying to fund that war effort, and that's not free. So what do we do about this? How do we position portfolios? So we'll talk a little bit about that, and I'll talk about the role of interest rates on valuations and inflation on companies' earnings and that growth slowdown that we're seeing, but also look at where we should have more optimism for markets going forward. So first of all, let's just put this in perspective. Here's a chart of the S&P 500 in blue and the volatility index, or the VIX, in red. And this is from 2015. And so what we can see is we're in a period where the level of the red line is critical, not so much it's bouncing around. But the level of the red line, the VIX, is high. I mean, we're at a level of volatility in the market that we haven't seen in a really long time. And it started with COVID. And, it's still well above what we had gotten used to back in the, 2015 to 2020 period. And, that's disturbing. And that in and of itself, that higher volatility does reduce valuations because whenever risk is higher, investors have to be compensated for that risk. They demand a higher expected return on equity, so the price of stocks tends to fall. And we've seen that in the valuations of stocks. So this is the S&P 500, and here's what's happened. This is about a month, about 3 weeks out of date. But the top couple of points here worth noticing. One is that the price of stocks on average in the S&P, right at the beginning of COVID, the market was trading at 25 times earnings. So that's $25 per dollar of earnings were being paid for a stock. As of mid-October, that had dropped to $15.50 per dollar of earnings. So that 15 times or 15.5 times multiple, puts stocks right now pretty much in line with the 50-year average. So I wouldn't say stocks are cheap right now, but they are a lot cheaper than they were at the beginning of the pandemic in February. Certainly at the bottom of the market after the pandemic was fully understood. And then even at the beginning of this year, after stocks had run up just enormously. So we're sort of back down into more normal levels for the market. But I want you to understand also that different stocks have behaved very differently. This is, again, pre-pandemic, January of 2020. The purple line is the NASDAQ, right? So it tends to be tech heavy, tends to be higher growth. And you can see that NASDAQ bounced back the most rapidly, didn't fall as much at the beginning of the pandemic, and it bounced back very quickly. Then we got to this period in early 22, where all of these companies had done extremely well during the pandemic, whether it was a Peloton or a Facebook or a Netflix or an Amazon, just saw their valuations really go very high on the expectation that the growth that they had seen in the pandemic would raise their level permanently, and then they would continue to grow from there. But what happened was risks increased during 2022. So even if the growth potential of these companies, didn't decline, and for some of them it did, the risk to that growth got bigger with all of the changes happening this year, the high inflation, the high wages, the shortage of labor, the war in Ukraine, and what that is doing to Europe more broadly. So the NASDAQ saw the biggest recovery, but also the biggest decline. But nevertheless, it's still above where we were pre-pandemic. And similarly for the S&P 500, we're still above where we were pre-pandemic. These other two that I've added here are dividend yielding components of the S&P. The DLN is an ETF that tracks the large cap dividend index. And the SPYD, the SPYD, is a high yielding dividend index out of the S&P, the top 60 dividend payers. And you can see that, initially, they were doing pretty well here. But even those have come down since interest rates have started to rise. And the reason for that is with higher interest rates, a few things happen. I'll talk about some later, but on the dividend side, it means that there are other alternatives to getting income. You can now invest in a treasury and get 4%. So there are alternatives, and that tends to depress the value of some dividend payers. Here's another chart I wanted to show you. This is a bunch of growth funds and indexes that I pulled just so that people could see how much growth-oriented portfolios and ETFs have come down. And this is basically year over year. We saw the growth stocks peak in early November of last year. And that was when the Fed was, a day before the Fed came out and said, you know what, this inflation problem is more persistent than we expected it to be. And we are going to have to raise rates in order to get inflation under control. So even before the Fed started to raise rates, they signaled it very, very clearly in no uncertain terms back in early November. And that's when we started to see all of these growth funds fall. And you can see which ones they are. The first one in white, it's in black letters up here, but that's the S&P 500. We have the NASDAQ in yellow, the Russell 1000 Growth Index, the Vanguard Growth ETF is the orange line. That's down 33% year over year, right? Our growth portfolio is down about the same. So if you're in the growth portfolio, I know it's been unpleasant. No, I personally wish I could have done better for you, but we have a lot of company here. At least we're not down here at down 45%. That I believe is the T. Rowe Price Blue Chip Growth Index. I mean, that's supposed to be all solid stuff, and it's down 41 or 43%. The other one is the All Cap Opportunities Fund, down 35%. So growth has just gotten hammered for a number of reasons. One, higher interest rates reduces the value of future earnings, right? You're discounting the future more. $1 a year from now is no longer worth what it was when interest rates were 0%. Now, short-term interest rates are 4 or 5%. And so consequently, a growth company, which isn't delivering you so much earnings now, it's delivering you earnings a year, 3 years, 5 years, 10 years from now. Well, those earnings out to the future are worth less in today's dollar when interest rates are higher and when inflation is higher, which is part of the interest rate equation. And so and that's one factor. A second factor is this elevation in global risks. Things that are, when the world is riskier, people pull back, investors pull back from riskier investments. And so we've seen a move in the market away from risky growth stocks towards safer consumer staples and that sort of thing. And so consequently, all of these funds have really gotten hammered. And this is true also for small and mid cap, because small and mid cap companies tend to be riskier. They are smaller companies. They might have a more narrow customer base. They might not have the balance sheets. And so consequently, those stocks are also ones that investors run away with during a period of elevated risks. So it's been unpleasant, but the other thing to recognize is just like we saw with the pandemic, where did that go? Hold on. Just as we saw the NASDAQ recover most quickly, once people saw the pandemic was fundamentally a temporary problem, we would also expect that as we get into the the guts of a recession, investors look beyond it and say, okay, recessions are temporary. Right now, we don't know when it's going to hit, how long it's going to last. But once we get into the guts of it and get a sense of the light at the end of the tunnel, we would tend to see growth stocks, just like the NASDAQ, recover the most quickly. So keep the faith. And this again, this is from mid-October. But the point was last quarter, right, what we saw was a pretty strong pullback in the dividend stocks, because we saw a bit of a flip between the risk on and risk off trade. You know, income continues to outperform on a year-to-date basis. These large cap dividend stocks down 12% versus the market as a whole, down 23%. That was again at the end of the third quarter. While energy has been the only thing that's been good, when you look at growth versus value, growth down 32% at the end of the third quarter, value still down 17%, 16.5%. So it's been tough to find a place to hide. And I'll talk more about what we've done in different strategies to try to protect clients and to position for the longer term recovery. Another thing I wanted to point out was how much we saw a recovery in consumer discretionary in the third quarter. Some renewed hope that things were going to get better. That proved to be a little bit premature. And then we saw some of the big guys in communication services really get hurt. So the only thing that's been good has been energy. And that's because the war has elevated oil prices because of restrictions on Russia and just demand for oil, with the pipeline service to Europe from Russia being cut off, both deliberately and through an act of sabotage. There has been severe problems with the supply of oil. And so oil prices have remained elevated, and we see OPEC now continuing to curtail supply. So we can expect the oil sector to remain pretty resilient, even with prices where they are today. So that's kind of been the only place to be. By the way, that's not typically a place where growth or SMID portfolios invest. Okay, so the other sources of decline year to date, right, are primarily found in multiples. The valuations investors are willing to pay for a dollar of earnings has dropped by 28%. Earnings growth has been positive this year, 5% roughly, but with a drop of that severity in investors' willingness to pay to hold a risky stock of 28% on average, you can see why we've had such decline. And we saw the investors and the analysts on Wall Street start to recognize back in sort of June, July, that earnings were likely to not come in as strongly this year as was expected. And so for the third quarter, for example, early in the year, earnings in July were expected to be as much as growth of 9.5%. But as of mid-October, just at the beginning of earnings season, those expectations had already dropped to 2% growth. And we're starting to see those numbers are coming in about that level. So it was important that the analysts did reduce those expectations in recognition that companies were facing more headwinds, whether it was supply chain, whether it was softening demand in some areas of the economy, or whether it was a generalized slowdown out of Europe or Asia. China COVID not being trivial to that. And across the board, whether it's this quarter's outlook also came down sharply, first quarter of 2023 and second quarter 2023. All of the estimates have come down. But look what happened here. Estimates for the third quarter of next year for earnings actually ticked higher. Right? So we're seeing a cycle, which is slower growth for a little while. This quarter looks like it's the lowest. Then we start to get recovery. Year over year, it's going to be tough in the second quarter. But by the end of next year, by the second half of next year, things start to look brighter again. We start to get up to annual growth, year over year growth of close to 9%. So now we don't know, right? That's just what the analysts are expecting now.
So
we don't know how long the recession is going to last.
So you think these numbers come from, they feel like inflation will be coming down and maybe we'll be coming out of a recession? Is that kind of what they're looking at?
I don't think they need to even assume that. So this third quarter earnings growth number is a year-over-year number. So what this partly builds in is that this year's third quarter is seeing very little earnings growth. So it doesn't take much, right, to get growth next year on a year-over-year basis. But it does seem to be assuming that whatever recession we get is not going to be that deep or long lasting. And what we're hearing from companies during this quarter's earnings season does suggest that the inventory problem they're having now, that a lot of companies have too much inventory, like PCs, right? Way too many PCs got produced. There was a lot that was needed during the work from home COVID phase. People ended up buying a lot of computers. Now there's less demand for a new computer. And so there's an inventory of them, and there's an excess inventory of the chips needed for those. And so they figure it's going to take about a quarter, 2 quarters to clear that inventory. So in the meantime, companies are building, PCs, fewer of them, and the ones they are building are using the chips they already have. And so it's only when you work down those inventories that you then start to get to sell at least to the level of demand that's out there. So for a couple of quarters, the PC guys, Hewlett Packard and Dell and the other guys are going to be selling fewer computers than are being sold to the consumer, because they're being sold stuff that's sitting in a warehouse, right? But by next year, they figure that those inventories are going to be cleared. And so they'll be able to sell again at a more normal level. And that means they're going to be selling more next year than they are this year.
Well, then that brings in the question I got to ask of the chips, because I know you are very knowledgeable about that. You want to cover that, or are you going to cover that later?
Yeah, no, we might as well do it here. I mean, so the chip is, upstream from the computers. So if there are too many computers out there, there are too many chips for the computers. So companies that specialize in computer chips like AMD, NVIDIA, Intel, and some of the other lesser component suppliers, right? They're also saying, hey, we've got too much inventory right now. We're going to, scale back on production a little bit, and we're going to just wait till that inventory clears, and then we'll be able to sell again. So they're all sort of saying it's going to take a couple of quarters to get that inventory cleared out of the warehouses, and then they'll be able to sell back at a normal level and resume growth. Now, that's not true everywhere. So PCs is one area where we do have that excess inventory, but servers that are going into data centers, servers that are helping companies move to the cloud, those are still selling very well. AMD Advanced Micro Devices, for example, is taking share from Intel, for one thing. That's good for them. But they're also saying that their demand for the chips that go into servers is very strong still. So this is why it's such a weird situation we're in. Some parts of the economy are still growing really strongly. Texas Instruments, for example, said that while they certainly have a slowdown on the chips they sell for PCs and for gaming systems and for other consumer electronics, that's all very weak, lots of inventory lying around. Industrials is a little bit weak, they said, but they said their chips for automobiles still growing very strongly, growing quarter to quarter to quarter. Because as I think if you've been out trying to buy a car, you recognize there's still a shortage of cars out there because they don't have enough chips to finish the cars. General Motors last quarter said that they had like tens of thousands of cars that they have to let sit in a parking lot because they're waiting for a chip to be able to put that car into final readiness for being able to be sold to a consumer. They're missing a chip, and they can't sell a $50,000 car because they lack a $1 chip, right? And so that's an area that still remains strong, and there's a lot of pent-up demand for cars. We're still seeing new car prices rise. Used car prices have started to fall, but that inventory problem, again, a shortage of inventory, it looks like it'll get resolved over the next few quarters. And so new car prices should start to fall again. So if you can wait, buy a new car, give it 6 to 12 months. Because
so what do you think about, so the chips are coming from Taiwan, Intel? Where are they coming from?
Yeah, so the chips are designed, a lot of chips are designed by US companies like Texas Instruments. They actually make their own, but AMD, Intel, NVIDIA all use outside manufacturing for their chips. So Taiwan Semiconductor is one of the big manufacturers. Samsung is another big manufacturer. And it's not for lack of trying. They are running their factories at as much as they can. It's just there was so much demand and there was such a long waiting list to get chips that they're still working through that. Some companies like Broadcom still are saying that for a lot of the chips that they supply to the server world, to the communications infrastructure world, they're still saying that they have a 10-month wait list. In other words, you place an order with them today, you're not going to get the chips for 10 to 12 months. That's how much demand they've been trying to catch up with. So there's still, again, areas of the economy still trying to catch up to demand, while other areas of the economy now have too much stuff, whether it's Pelotons or bicycles or PCs. So earnings growth is slowing on average, but not uniformly. Energy companies are seeing earnings rise. Chip companies are seeing earnings lower. Some consumer companies are doing just fine, like Constellation Brands that sells beer, right? They're seeing very strong demand. So it really depends what kind of company you are, how you're feeling the current economy. But what's interesting is that the number of stocks making new lows has gotten smaller, fewer. There are fewer of them making new lows now. So that could suggest that we're near a bottom. By that I mean, if we're seeing fewer stocks making new lows, it sort of suggests that investors have reconciled the fact that things are weaker now, and the stock prices have come down to reflect that weaker outlook. Okay, now I did want to touch a little bit on fixed income because I know it's probably relevant to a lot of the folks that are listening. And one of the things that has happened right over the last year is that interest rates have risen. And so fixed income all of a sudden is delivering yield like it never did before. In our group, we have several different varieties of fixed income strategies that are paired up with the balanced strategy. And then we're able to get 4 or 5% yields across that part of the portfolio. So clients are now getting the income. The idea here is can you ride this out, right? We know these stocks are excessively volatile right now. It's very unpleasant. But if you're, folks that are in retirement that are using the cash flow off their portfolio that come from dividends and come from fixed income, right? They're getting more yield now on the fixed income side, and that's helping a little bit. We're hearing from other folks among our group that they're really appreciating the fact that they're getting more cash off of their investments to be able to ride out this period of volatility. And so that 10-year is up around 4%, and that has though coincided with equities having fallen a lot. Okay, so what have we done on the fixed income side is we've kept our duration very short. By that, I mean sort of a combination of maturity and yield. So our average maturity in our fixed income strategies is somewhere around 3.5 years. And what that's done for us is it means that we're often able to upgrade the bonds that are in a portfolio to the higher yielding one that's come along in the last few months.
More like a laddered approach.
Yeah, kind of. I mean, we're keeping it pretty tight. Like most of the things in the portfolio will have a maturity of between 3 and 4 or 5 years. And so but I think as you're pointing out, Kelly, right? Because then they end up expiring or being called or maturing. When they go away, we're able to re-up with something that has an even higher yield. Yeah. And so we've taken advantage of that. Okay, so we've talked about some of this already. I've kind of intertwined things here, but let's make sure we haven't missed anything important. Well, there's that inflation discussion. Obviously, inflation is high. And this is a long graph. It's from 1972. So those of you that were around back then, remember having to alternate days to get your tank filled in your car, right? And remember, maybe like I do remember my parents being very happy that they had a 5.25% mortgage when interest rates were 22%.
Yeah.
Right. And that was regime shift that took place at the Federal Reserve when Paul Volcker came in, adopted a new approach and got inflation under control. That regime is still in place. And we have this spike in inflation now because of the pandemic and because of the response to the pandemic taken around the world, primarily in the form, two steps really contributed to the inflation. Three. First of all, was a shortage of goods because of the pandemic. Less manufacturing, less services, less everything. The second thing was the monetary authority stepped in and injected liquidity into the system so that we wouldn't have a breakdown of the financial system. And then the third thing, and this happened all over the world, and the third thing was the fiscal authorities around the world made transfers of income so that the population and particular elements of the population wouldn't starve and wouldn't be thrown out of their houses, which was the key thing. So people weren't working, they couldn't make their mortgage payments, they couldn't make their rent payments, they would be thrown out of their houses. What would happen then? Not only would that be bad for them as humans, but it would also be bad for the housing market because you'd end up with another wave of foreclosures like the one we saw back during the great financial crisis. So unfortunately, the fiscal authorities around the world were unable to target those transfers of income, right? Those transfer payments that went out, those checks that we got, right? It was very difficult for them to say, we're only going to give it to these people who need it, because they couldn't tell who was going to need it. They didn't know who was going to lose their jobs, right? And so we ended up with these big, three, how many, I forget, under Trump and under Biden, right? We had fiscal transfers of income to the population to keep them in their houses and to enable them to eat. Now, obviously, some people didn't need the money, and we saw savings go up. We saw a massive accumulation of savings on average across households. And so when things started to reopen, we got a massive surge of spending, but manufacturing hadn't caught up yet, right? They were shut down for a while. So we still had goods shortages at the same time that people were out there spending like crazy. And so inflation, shortage of goods, lots of spending, inflation. And so that's where we are now. And it's just going to take time to work that back down again. So the monetary authority, the Fed and central banks around the world are trying to pull back, trying to discourage borrowing by raising interest rates, making it more costly to try to curtail spending so as to bring supply of goods and demand for goods back into balance. And it's just going to take time. And it's going to take higher interest rates. And that's, makes it also hard though for businesses because they don't know how much consumer spending is going to drop in the face of high inflation, which makes stuff more costly. But also in the face of higher interest rates, which tends to discourage things like home buying, tends to discourage things like car buying, although we haven't seen much effect there. But it also tends to discourage other durable goods purchases, other long-term purchases and activities. And so, we are certainly seeing a consequence of the rate increases already. We're starting to see consumer spending slow, and we're certainly seeing it in the housing market. And so, we have to recognize that it's a very difficult ship to steer. The Fed will certainly try not to curtail spending and economic activity any more than necessary, but it's going to be a challenge for them to thread that needle. And that's why investors are preparing for a bad outcome, for recession, for a lower level of economic activity and earnings growth and sales than might actually happen. We just don't know yet. So this is one of those economic cycles that we occasionally run into, and it has almost all the hallmarks of recession except for one. And the one it doesn't have yet is unemployment. Unemployment is really low. Job market is really hot in the United States, right? We have about 2 job openings for every person looking for a job. And that is keeping the pressure on wages. And wages is a cost of doing business. And so firms tend to want to raise prices when their labor costs are going up. And so it's a very challenging problem for the Fed to solve at this point. And then you have, of course, high gas prices as well, which is beyond any politician's control. The Fed can't control the global price of oil, and neither can anybody else. So it's a very difficult problem for the Fed to get inflation under control. But in terms of recession probabilities, they are definitely moving to reduce spending, to reduce economic activity more broadly, to try to tamp down demand for labor so as to take pressure off wages. Those two things will tend to reduce inflation. It's just going to take some time to get there. In the meantime, though, people have jobs. People can get jobs. So it's not looking like it's all that painful yet. And we just don't know really how we're going to get from 8% inflation or 6% on the core down to 2% inflation, which is the Fed's target. So we got some ways to go.
I have a question from the listeners here. What about pharmaceuticals? Okay, what do you have to say about those?
Yeah, so when we look at how to position portfolios in this kind of environment, one of the places we like is healthcare. And I'll give you that as an example of a broader approach, which is look for areas of the economy that are likely to continue to grow even during a recession. Pharmaceuticals are driven largely by health issues and by the government approach to medical insurance, right? So barring a change in the medical insurance environment, which I think is probably a reasonable assumption to make, I think it'd be very hard to overturn something like the Affordable Care Act. Pharmaceuticals are going to tend to see their end markets continue to grow because the US population is aging. You have to worry a little bit about regulation, right? There was that regulation passed that would enable the US Medicare system to be able to negotiate for prices, but the list is very limited on what they can negotiate. So overall, we like pharmaceuticals as a pretty defensive way to be positioned in the market. Plus, a lot of the pharmaceutical companies do offer pretty good dividend yields. So, when we look at inflation, and maybe that was part of the pharmaceutical question, generally the pharmaceutical guys and several other types of companies out there can raise prices to keep up with inflation. I mean, inflation is the rise in prices on average. So inflation doesn't exist in a vacuum. Inflation exists because companies are raising prices. So that means it's showing up in their sales numbers. It's showing up in their earnings numbers. And you can see where it comes from, which kinds of companies are raising prices. The energy industry, for example, a big component of the inflation story. New and used cars has been a significant contributor. Food, obviously, think of the war in Europe, right, contributing to higher grain prices. And then housing. So house prices went up a lot, rents went up a lot. That is now, in terms of how the index is calculated, is filtering into the inflation calculation. And that's likely to continue for a while. But the good news is that the long-term expectation among the professional forecasters, even among consumers, is that inflation, on average, for 10 years is likely to get back towards the Fed target of 2%. And so that's a good sign in terms of the credibility of the Fed and the expectation that, yes, they're going to get this under control, which is a pretty important thing for the economy to have relatively stable price environment so that firms can say, I'm going to ship you something in a year. It's going to take me a year to build something. Here's the price. If they have to build in an inflation factor to the price, that makes it, they don't know exactly what it's going to be. It makes it potentially harder to sell the product if there's that uncertainty. So stable prices is pretty important for businesses all around. So it's a good sign that expectations are pretty well anchored close to what the Fed has as its long run target for inflation. Okay, but in the meantime, unfortunately, we have this short-term interest rate situation. This is the policy rate of the Fed, called the federal funds rate. And that has been rising. The Fed just raised it by 75 basis points yesterday. So now it's at a range of between 3.75 and 4.0. So this is, again, before that rate, this graph was printed before that rate increase. But so it's expected to continue to go up. And the Fed said yesterday, hey, it's actually going to go up more than we originally expected. So these numbers have all moved higher on this graph, and now it's sort of more like the 4.8% or 5% as a peak rate for the federal funds rate is now what the market is expecting. And it'll probably stay up there for a little while before the Fed starts to bring it back down, because the Fed needs to make sure that their actions are tamping down consumer demand and tamping down the demand for labor to a sufficient degree to take the pressure off of wages and prices. Okay, but you know, it's still not that expensive to borrow when you think about it, right? When inflation is 6 or 8%, depending on which metric you're looking at, and interest rates, even mortgage interest rates, are 7%. Well, the real interest rate, you know, look at the amount you're actually paying, subtracting inflation, is pretty low. And so money is still pretty cheap in the economy right now. And so that is also, I think, proving to be a challenge for the Fed. And that's why I think they're saying, hey, we got to raise rates more than we originally thought. Okay, we're going to skip that one. All right, so the labor market's strong, but we're starting to see more and more layoff announcements. In fact, you probably saw today, Twitter, right? Elon Musk, originally the rumor was he was going to fire 75% of the workforce. People sort of freaked out and said, oh my God, what is Twitter going to become? But today, now the rumor is, and I don't know whether or not this is confirmed, is that they're starting layoffs of between 25 and 50% of the staff. Now, that's just one company, but we're starting to hear more companies announce this. In fact, I read something today from the search firm, Challenger Gray and Christmas, and they said 48% of their clients have announced layoffs. That's a big number. And so it does look like potentially we should see some easing of that labor market tightness. And that could take some of the pressure off of wages. We're starting to see people are still quitting their jobs. This is a little bit old, but we just got the new data this week. It's about the same level. So there's still a lot of jobs out there. So the layoffs that we're seeing, you know, even as they grow, it still seems to be very specific to industries. The tech industry, which hired a bunch of people, Amazon needed a bunch of people for their warehouses. They need fewer now, right? Some of the tech companies just got fat with too much staff, and they need to focus more on delivering earnings as opposed to just delivering sales growth. And so they're doing reorganizations, but it doesn't seem very broad-based, at least not yet. So if you're asked, hey, are we in a recession? Well, just tell them the unemployment rate is still 3.5%, right? Why don't we like recessions? Because people get fired, right? People lose their jobs and they can't pay their rent and they can't pay their mortgage, right? And then they stop spending because of that. So we're not to that level yet, and we don't know if we'll get there. We think it's likely we'll get some level of recession, some increase in the unemployment rate in order to take that pressure off of wages, in order to take that pressure off of price rises. But it's probably going to be a slow process. And there are other reasons why in the interim, inflation is likely to ease. And I'll take you back a couple slides. 1, 2, 3. Where'd that go? This. So if energy, if new and used cars, if food at home, right? If these prices just stabilize, they don't have to fall. They just stop growing. Then inflation goes to zero, right? Inflation is a change in prices. So, and we do expect, we've already seen, in fact, used prices are falling. And so this little component here could disappear once the new cars start getting off those parking lots with the last chip, right? Energy prices per gallon, right, per barrel of oil have started to stabilize. So if we lose the inflation in energy, if it just stays at a high level but doesn't go up any further, then that component of inflation goes to zero. Used car prices fall, that component of inflation becomes negative. New car prices stop rising, that part becomes zero, right? And then you're left with housing. And that's going to take another 4 or 5, 6 months to play through. So that's going to be a positive component of inflation for a while. But these things up here should start to drop down to zero. And that's why a lot of folks are saying that inflation is probably going to drop to 4% by early next year. And that should give people some comfort that at some point the Fed right, which is raising rates now, we'll be able to stop raising rates at least and let this play through and then start to cut rate. So, the enthusiasm you see in the market now and then, stocks go up like they did in October, and then yesterday and today, right, they go down because, oh no, the Fed said we're gonna have to raise rates more than we thought. Well, there are more rate increases in our past than are coming in our future. We've gone from 0 on the federal funds rate, 3.75 to 4%. Where are we going? Terminal rate, probably 5%. So maybe another percent. But that headwind of stocks, particularly growth stocks, right? That headwind is disappearing. And then if we get to a point next year where rates actually start falling again, then that becomes a massive tailwind. Okay.
So you like for the longer term right now anyway, see, it sounds like you're saying you like growth type of stocks because they're beaten down quite a bit and they've got a better chance of coming back.
Yeah, and I'm sorry, this is a lot of words on a slide, but let's just talk about portfolio positioning. Since we're talking about growth, it really depends on your clients, Kelley, right? Each of you out there, like, what is your time horizon? If your time horizon is 3, 5 or more years, right? 3 or 5 or more years, then growth stocks have become pretty cheap right here. And again, that headwind of rising interest rates and lots of risk, well, at least on the interest rate side, we expect that to reverse sometime next year. And I can't tell you when. If I knew when, I would have said back in January or February after the war started, okay, well, it's only going to get worse from here. Well, actually, at that point, it almost looked like we were at the worst, right? We saw what the Fed was doing. Okay, they're getting this under control. A little bit of a rate increase, fine. But it just got worse and worse and worse. So I can't tell you how patient you'll have to be. But I can say if you have a 3 to 5 year horizon, growth has become cheap. It generally is the first to rebound. And we do think that, by the middle of next year, we should start to see the interest rate headwind turn into a tailwind. Okay. So that's what makes growth appealing. And the same thing is true for SMID, right? You had this flight from risky, growthy stocks, plus rising interest rates, caused all those valuations to come down, that so-called risk-off trade. We saw strength in consumer staples, strength in energy, strength in utilities, right? When investors realize, when your clients realize, hey, I need to build my portfolio for the future, I need for it to grow, you need to own companies that can deliver higher sales and higher earnings, right? And that means, utilities, they don't really do that, right? Consumer staples, they don't grow that much. So where do you go to find companies that can grow? Well, you got to be in the end markets that are growing. So cloud computing, data centers, these are being forced higher because, more internet usage, whether it's video, TikTok, Twitter, whatever, streaming, right? The demand for internet pipes, the data that's carried through the internet is continuing to rise significantly. And you need more data centers, which means you need more servers, which means you need more software, which means you need better protected software because cybersecurity is only going to be a incredible need going forward. You look at all the hacking that's going on. So if you look at end markets that are growing and you look at like healthcare, medical devices, right? Look at the demographics, more and more people needing knee replacements, more and more people needing heart interventions, vaccines. If you think this is the last pandemic we're going to face, well, the experts I'm reading are saying there's an awful lot of viruses out there that we humans have not yet seen. And with all of the travel that we have now and the spread of the population into the edges of rainforests, into the edges of forests that never had seen humans interacting with animals, we're likely to see a continued demand for vaccines. So there are a lot of places you can look and understand where the demand is going to continue to grow. And that's if you own those companies and those companies serve a growing market, their sales rise over time, their earnings rise over time, and their valuations rise over time. And so, that's an opportunity. But some folks, don't want to deal with that level of patience, right? They don't have it, or they just need cash flow. And that's why we have the income-oriented strategies that we do, the balance strategy and our income with growth strategy. And as you know, right, we have balanced in different varietals. Since you guys are in California, I can talk about varietals. We have the T3 balance that has about a 3 to 3.5% yield, gross yield. We have a T4 balance, which is like a 4.5% yield, and the T5 balance, which is currently yielding about 5.5%. Income with growth is up at the 6.5 to 7% yield level, and that's a combination of equity yield and fixed income. So a lot of folks like to own those kind of stocks, particularly during volatile periods, and says, you know what? I don't want to have to look at the stocks in my portfolio. I just want the dividends. I want the coupon payments. I want to live on the cash flow, and I just want to wait this out, this volatility. So for folks that are like that, those strategies are really working well, and they've actually held up very well in this environment, those income-oriented strategies. They tend to have more energy exposure, more financials exposure, more REIT exposure, things that have been relatively stable. Relative is a relative word in this context, but that's held up pretty well. International, though, if you want even further diversification, Europe stocks have really gotten crushed because of fears of a deeper recession, because the war is in Europe. And those valuations have become particularly attractive. So we counsel diversification just like you do, Kelley. You've added to diversification by having those alternative investments. But even within the stock universe, there's a way of diversifying, whether it's across income, growth, or international, that can really help folks be positioned for the next 3 to 5 years. So one of my colleagues likes to say, don't focus on the current crisis. Focus on your investment strategy for beyond the crisis. Like, where are you going to be?
Yes, and I agree with you, because you don't want to trade emotionally. That's in my book, one of the 6 biggest blunders, right? You don't trade emotionally. The other thing I want to reiterate for you, all of you, and I see some questions coming in that I think are being answered here. But remember that Advisors Capital, what they do specifically, and why I love JoAnne so much, and what she chooses for clients' portfolios is individual stock positions or bond positions if you're in a bond portfolio. But for the most of my clients are in stock positions, and it just depends on the strategy we've chosen for you. So the small to mid cap might not have real estate programs in it, or pharmaceuticals if it's a dividend paying type of security. It's going to be more growth oriented. If you're more income oriented, it's going to have some of those income oriented stocks that are not the growth ones that she's talked about here. So just look at, if you're interested right now and you want to go look at the stocks that you own compared to what Dr. Feeney's talking about here, it depends on the strategy you're in. So we can always change it. Now, there might be tax consequences for that, so I don't just willy-nilly change strategies for people, but just be aware of that.
Do you want to field any other questions, Kelley? Guys,
Well, I'm looking at it here. I think you've answered a lot of them. Yeah, I mean, yeah, keep going.
Yeah, this is kind of the slide I wanted to conclude with. This just shows you the dispersion that we're seeing in valuations in the market. This is just the S&P 500, but we're seeing a pretty wide range of valuations from stocks at 25 or more times, down to less than 10 times. I was on when I'm on Bloomberg or CNBC. I've been on the last couple of weeks, and I always like to provide, when they ask me for some ideas, I like to give them a few different buckets. What's income oriented? Where can investors go to hide? What's structural growth? Like, where's the multiple years of growth? What in the economy is growing or in the world? But the third category I like to give them is, what are some cheap stocks, like single digit valuations? You're paying $8, $9, $6 for $1 worth of earnings. And why do we like those? And so there are places to find value in this market. Housing right now is out of favor, but because high mortgage rates, I get it. But on the other hand, there's a lot of millennials out there who have yet to get into their first home, and rents are really high. And yes, they had to reevaluate when mortgage rates went up to 7% instead of being at 5% or 4%. But that just means they're going to have to get a smaller house. They're going to get one with fewer bells and whistles, right? Maybe not so great end cabinets, but they still need a house. And so while there's a readjustment going on right now, the home builders still seeing, certainly less. They're planning fewer builds, but what they're also saying is that their potential clients are basically recalculating and saying, okay, now, oops, this is the house I can now afford. Go build me this. And existing homeowners don't want to give up their mortgages, right? You got a mortgage at 3.5%. You're not going to sell your house and get into a 7% mortgage. So existing homes, are fewer on the market in terms of that entry level. And so, we think that the millennial buying group, the data shows us that they're substantial. And that after this adjustment period, when they figure out, okay, I have to buy a smaller house, there's just a lot of years of growth ahead in the housing market. So one of the names in the growth portfolio is a company called Lennar, for example. It's trading at 6, 7, 8 times earnings. It's very, very cheap. And it has many years of growth ahead of it. So this is the kind of thing where you have to kind of really dig into the fundamentals to know what the end markets are likely to do, understand the risk and how long it's going to take to get there, but you take advantage of these times. And so, we've continued to reevaluate every position in all portfolios. Our approach is, would you be buying it today? And if you would buy it today, then even if it's come down 40%, you don't sell it, right? What is it going to do for your client for the next year, 2, 3 years? That's the relevant question. What's the best place to be right now for the client, depending on their goals, whether it's, again, appreciation long-term or whether it's income needs?
Yeah, and I think, to your point, the different strategies you guys have available are wonderful, because if you want income, you'll choose income stocks. If you want growth stocks, we'll do that. And I say this all the time on my radio show. I say this all the time to clients that I chat with. Stay the course. You have a plan. We make a plan for you. We don't trade emotionally. We don't change the plan just because some news has come out. Yes, we manage through markets as Advisors Capital does too. They're going to get rid of stocks that they don't feel are going to recover well. I've seen you do that, JoAnne. You did that all through COVID, and God bless you for that, because you guys really managed through that beautifully, I have to say. So they buy individual stocks. They don't hedge. So your long positions, most of them, depending on the strategy you pick, certainly, but long positions, they're not buying and selling every day. Right, JoAnne? You guys like to buy and hold things. Yeah.
We think you're an owner of a company when you own the stock. And there's too much noise in the market to consistently, successfully trade in and out of stocks. And we've seen that noise more so in the last 2 years than we've seen in a really long time.
Yeah, don't trade emotionally. I say that all the time too.
Right.
Yeah, okay, well, I think we've answered a lot of the questions here. Do you have anything else, JoAnne?
No, that's it. I want to give folks some sense of how long things take to recover. These are bear markets. This is the worst of the worst, right? And this is the number of months to fully recover, get back to where you were before. And, back in the financial crisis, that was a bad one. We're not in that situation. We don't have a broken financial system that needs regulation to fix. That's what we needed back in 07 to 09. Okay, we're not in OPEC oil embargo. We're not here. We don't have a shortage of oil in this country. Other countries have a shortage of oil and the price is a bit high, but compared to the price that you were paying back in the 70s, gas is actually still cheaper. So we're not here either. We don't have a country dominating the oil market and not giving us the oil. We're not there. Okay, so we're more like, 87, 90, 2000 maybe, but this was actually 2 pullbacks and 2 recessions in one.
Right.
So, we're more in the situation of, 19% decline. I know we went over 20, went to 22, but, you have to be a little bit wary of saying, hey, maybe I should just get out of the way of this thing. I mean, during that recession in the early 80s, it took the stock market from 1981 September, just 4 months to fully recover from a 19% pullback. It can happen fast.
Yeah, yeah.
Because investors are forward looking. So this is kind of my warning of don't panic, don't don't get out of the market, right, things can recover in a hurry. And, we have our little recession. We had a couple of recessions in the early 80s, but the market was volatile. It recovered, it pulled back, it recovered, right? If you happen to have been out when it recovered and you were only in when it went down, boy, did you damage your long-term wealth.
Yeah.
Right. And then other times, 2009, 11, and we had a bit of a pullback. There's just been a lot of experiences. If you've been around the markets long enough, this happens. You get these significant pullbacks, but most of the time the recovery is pretty quick. Now, we've been in an extended pullback since November of last year, right? So we're already into this about a year. Investors will start looking forward. They're wanting to see the light at the end of the tunnel of Fed rate increases. They're wanting to see inflation come down. If inflation is 4% a few months from now, what do you think, right, investors are going to recognize? They're going to recognize that the Fed is getting inflation under control. They're going to start looking forward to the day when rates can come back down.
Yeah, well, that's why I say to have a diversified portfolio and don't trade emotionally, have a plan and stick to it. I mean, I can't say that enough here. It does behoove you to have a plan, stick to it. And this is another reason why I like Advisors Capital and Dr. Feeney, because they buy individual stocks. They're much more nimble with the market, being able to do that. And the fees are less too, because you're not in a bunch of mutual funds, which never go out of the market or managed through markets. So I prefer to have individual stock portfolios like Advisors Capital does.
Well, and also this is tax loss harvesting season, right? So if you have a non-qualified account and you've got capital gains sitting around, because maybe at the beginning of the year, you found yourself overweight in a stock or something, or maybe you came over from a different portfolio, right? We're doing the tax loss harvesting now. We're selling positions out for 31 days, right? Buying them back to capture the losses. So that's what you can do with individual stock portfolios that you can't do with mutual funds. Some of the mutual funds this year are really going to hurt their clients because they've held Apple and Amazon and Facebook for many, many years, and they had all this appreciation. They trimmed them early this year, right, to reduce their tech exposure. That meant they had, in some cases, 20 years of capital gains,
right,
that every mutual fund owner has to take a share of,
right,
even if they'd only been in the fund for a month or a day.
yeah.
And so they're really
You can't
stuck.
tax harvest with mutual funds. Again, another
Right.
reason why I like individual stocks. Absolutely. I'm glad you brought that to our attention, especially this time of year, because that's what portfolios will end up doing. And you won't like that tax bill when you get it next year and your value's down in those mutual funds that you might own. So yeah, good point. Okay, well, thank you, Dr. Feeney. I think you've got your contacts up there. Listen to her on Bloomberg, CNBC. It's always fun to see. It's always fun to see your smiling face up there when I go, I know her. So thank you. I appreciate it. Everybody that's on the call, by all means, send me some questions if you have those, and appreciate it, Dr. Feeney. Have a good evening, everyone.
Yeah, thanks, Kelly, for the opportunity to talk to your team. It's always fun. I wish I could be there in person, but another time.
Well, we'll get you out here someday.
Okay, sounds good. Take care, folks.
Okay, bye-bye.
Bye.